A very good morning, friends. So, I hope you're all doing well. So, everything has to come to an end, and so would financial instruments come to an end today. But of course, your journey will start from that particular point. So, we have covered a lot of aspects in terms of financial instruments, Index 32 as well as Index 109. And we are now on certain special issues related to financial instruments in Index 109. My focus today is going to be on three agendas related to financial instruments. One is the concept of hedge accounting. The other one is in terms of impairment of financial assets, what we popularly call the ECL, expected credit loss model, in terms of impairment testing of financial assets. And the third is accounting in terms of embedded derivative, when the instrument becomes something what we call hybrid in nature, which contains a derivative as well as a non-derivative. How do you segregate the derivative and how it is accounted for? How the host contract as well as the derivative embedded in the contract is accounted for. So I think let's start with a little technical area. I think early, fresh in the morning, I'm going to take advantage of that. So I think I'm going to start with the concept of hedge accounting. Though, I guess if you look at the frequency in terms of these areas, I think more or less if you compare it with the earlier areas, the frequency may not be too great. But I think as we are going to progress, I think the frequency of these areas should also increase in the exam, because hedging is something which is very relevant in the practical world, of course. And impairment is also something which is very much relevant indeed. I think as we are going to see, typically I always tell people as the banking sector is going to apply Ind AS, though I think the concept of ECL has already been applied. But once they're going to apply the concept of Ind AS, then you'll see the level of importance in terms of, you can say, both hedge accounting, typically, of course, impairment is going to increase manifold. But of course, we are not going to make you experts on this area. The idea is, of course, to look at things from the examination perspective. So I think let's begin the journey. So I'm going to first of all give you the concept revision on hedging, and then we'll do some questions on hedging, then go to the impairment, then go to derivatives. And I think the time permits, if it should, then I think we'll do some practice questions on the entire area of financial instruments, pick and choose a few questions as well, apart from these areas as well. So let's, I think, begin with the concept of, first of all, hedging. Well, as far as hedging is concerned, it is basically protecting a company, you can say, against unrealized losses, or even trying to keep your unrealized gains intact. So the objective, so once you look at hedging, the objective which immediately shoots into the mind is that when we're looking at the concept of hedging, there are two objectives in hand: either to protect against unrealized loss. I'm putting it as UL. So it is either to protect yourself against an unrealized loss, or you can say trying to keep intact the unrealized gain. Because many people have got an apprehension that hedging is a technique which is typically used to protect yourself against losses. But I think let's keep it very clear. The concept of hedging works on both the ends. There is an unrealized gain you want to protect and keep it intact. There is an unrealized loss you want to basically ensure that you are not impacted by the unrealized loss. Secondly, we also need to consider that this is completely optional in nature. The company wants to carry out hedging or not is completely optional. It is not mandated by the standard. So that is the initial input. The next is, when you are applying hedging, then I would say there is again a step-by-step procedure. But this time, of course, it's not going to be a 3-step model, but it's going to be a 5-step model. So when you're applying the concept of hedging, we can say that there is going to be a 5 sequential steps. So how are we going to proceed in terms of hedging? Apply a 5-step model. So let's see, first of all, what are the 5 steps, and then we can get on to a little details on each of these steps as well. The very first step in terms of hedging is to identify what is called a hedged item. what is called a hedged item. So we'll talk about this, not an issue. But in simple words, we can say hedged item is something which you are trying to protect. So what asset or what liability the company is trying to protect against the unrealized losses or keep the gains intact, that becomes the hedge item. The second step is identifying what is called the hedging instrument. And this is basically, you can say, the tool with which the protection is being done. And typically, the protection is done with the help of derivatives. So I've not, given you any inputs on the accounting of derivative, but I think I'll talk of that within the concept of hedging itself. Then the third step in terms of after the item and the hedging instrument is identified, we need to consider that we meet what is called a qualifying criteria. We meet what is called a qualifying criteria. Because if the company wants to apply the concept of hedging, what is important is that they meet certain parameters. And one of the important parameters is looking at what we call the hedge effectiveness. And the other one is what is important is the formal documentation. But we'll talk of that. Then the fourth step is identifying the type of hedge to be applied. So what is the type of hedge to be applied? Though there are typically three kinds of hedges. One is what is called a fair value hedge. The second is a cash flow hedge. And the third is a net investment in a foreign operation, that is NIFO. So the company has to consciously decide that what kind of hedge are they going to apply. Of course, we may not be tested that level that, what kind of hedge is to be applied. That's more or less directly, indirectly always stated in the question, because managements would, choose a different kind of hedge. A given situation, a particular management may decide a fair value hedge, and in the same situation, another management may decide another kind of hedge. And then finally comes, how would you do the accounting of this hedge once you've identified the type of hedge? So basically, what comes to the mind is a total of a 5-step model when you're looking at hedging. Get the hedged item, what you're trying to protect, get the hedging instrument with which the protection would occur, meet a qualifying criteria, and identify the type of hedge, and then finally apply the accounting. So let's now take a little, inputs, a revision in terms of each of these 5 steps with you. So let's make a small little chart, creating a small little mind map in terms of each of these 5 steps. So as I said, it's going to be a 5-step instead of a 3-step model, which I generally tend to give. But this time we're dividing this into a 5-step model. So let's have a look at what is to be seen within each step, the main broad parameters to be seen. So when you're looking in terms of the first step, the first step is, as we said, identifying what is called the hedged item. Now, as far as Ind AS 109 is concerned, a company could protect anything. It could protect what is called a recognized asset liability. It could protect an unrecognized asset liability, which means the asset liability is already in the balance sheet. That's called recognized. Or the asset liability is not in the balance sheet, but still there might be a future asset liability which you want to protect. So the company, while deciding the hedged item, can either protect what is called recognized asset or liability, which is already in the balance sheet of the company. Or they may try to protect what is called an unrecognized asset or liability. Now, when we say that they are trying to protect an unrecognized asset or liability, you can say there are 2 kinds of unrecognized assets and liabilities as well. One is called a firm commitment, and the other one is supposed to be, you can say, a forecasted transaction. Now, a firm commitment is where the company is already entered into a contract. So there is an unavoidable obligation that you're going to definitely, do the transaction, execute the transaction. Or the company is not yet entered into any kind of transaction, but there is a high probability of the transaction happening. And that is called a forecasted transaction. So the unrecognized asset or liability could be on account of what we call either a firm commitment Either it is on account of a firm commitment where the company is already entered into a particular contract to be executed at a future date, or it could be a case of what we call a forecasted transaction. There is a high probability that in this particular case, this transaction is definitely going to occur. There is a good chance of the transaction happening. So, in any case, when you read a question, your first focus should be in terms of identifying that this is the item which the company is going to protect. So, does that make any difference whether it is recognized or unrecognized in nature? Yes. Generally, when you are considering the concept of, you can say, a unrecognized asset liability, when it is a case of a firm commitment, generally a fair value hedge is applied. And when it is a case of a forecasted, highly probable forecasted transaction, in those particular cases, generally, you can say a cash flow hedge would apply. But of course, we need not bother too much on that because the kind of hedge to be applied will be given. So this is not going to be a very crucial step in terms of identifying what the company is trying to protect. Then comes the second step after the hedged item, and that is getting what is called hedging instrument. What is called hedging instrument. So in terms of the hedging instrument, you can say it is basically, you can say, the tool with which the protection is done. And generally, I'm not saying always, but generally, at least you can say from the examination point of view, and of course, even practically, the derivatives are the instruments with which the protection is done. So when the company is going to use the hedging instruments, you can say they are going to consider derivative instruments. So they're going to consider derivative instruments for the purpose of protecting themselves. And I guess you all know that derivative instruments could be in terms of forward contracts, in terms of futures contract, in terms of options, as well as in terms of, you can say, swaps. Generally, when you look at a derivative instruments, you're going to see four types of derivative instruments which generally one comes across. So one is, you can say, forward contract. The other one is what is called a futures contract. Then it is options contract. And then it is supposed to be the case of what we call swaps. Now, I have not covered the derivative accounting, so you can take a choice. You want me to first take an example on a pure derivative accounting? Because initially also when I started with Index 32, I just made a focus in terms of non-derivative contracts. Though of course I gave you that in terms of a pure derivative, there is an element which is called a fixed for fixed test. So you want me to do a questions on, maybe one question on a derivative instrument?
Yes,
You
sir.
can exercise a choice.
Yes, sir. We'll do it.
Okay, so we'll do one question, I think typically on the option contract, because I think that gives us a little more better understanding of things. So we'll do one thing before we get into the hedging. We'll take one question to understand the accounting of derivative instruments. But I think, let me just, quickly, recap and tell you, derivative instruments are always recorded at fair value through profit and loss. Now, whether it's a financial asset or it's a financial liability, derivative instruments are always taken at mark to market. That's what we call M to M, mark to market margin, and therefore they're always accounted at fair value through P&L, FVTPL. Okay, then comes the step number 3. So once you've identified what you want to protect, you've identified what is the tool with which the protection is going to occur, then comes the third step of meeting what is called a qualifying criteria. Then it is looking at what we call a qualifying criteria. Now, there are a couple of qualifying criterias. Like, for example, the first thing is to see that the company is trying to protect what is called eligible hedged item. The company is trying to use a hedging instrument which is eligible hedging instrument. The third is what I said earlier, a hedge effectiveness. A hedge effectiveness would mean that if you've entered into a derivative contract, then you all know this very well, that if there is a gain in a spot market, you're going to get a loss in the derivative market. And if there is going to be a loss in the spot market, you're going to get a gain in the derivative market. Because in any case, the positions which you take in a derivative market, they will always give you an offsetting advantage. So it's not necessary that the amount of gain in a spot market is equal to the loss in a derivative market. But yes, one thing is, of course, always true, that if you get a gain in a spot market, you'll definitely get a loss in the derivative market and vice versa. So we need to ensure that once you offset the gain in a spot and a loss in a derivative market, they give you a maximum offsetting advantage. Well, there has been no percentage which is defined in IFRS or in terms of Ind AS that what should be the percentage to achieve a hedge effectiveness. Though, of course, if you look at US gaps, they tell you that it should be in somewhere between a range of what we say 90 to 125%. But in terms of Indian accounting standard, there is no prescribed limit, and we don't, Indian, from the examination point of view, get into the testing of the effectiveness. But you need to know that, once you are carrying out a hedge, the company needs to ensure that there is going to be a hedge effectiveness. You know that the loss in a derivative or the gain in the derivative is got a good offsetting effect from the spot market. And another important aspect in terms of hedge is a formal documentation. Because you'll see very clearly in terms of accounting, when you bring the hedged item, when you bring those items under the purview of hedge accounting, the normal accounting does not apply, typically in terms of fair value hedge. So documentation is important because the company, the auditors, the stakeholders can understand that this item now is under the scanner of hedge accounting. So I would say typically the qualifying criteria would be a total of at least 4 elements which you need to see. Though from the examination point of view, again, we just need to conceptually know that yes, these are the 4 elements. So one is we need to see that we've got an eligible hedged item. The item which is being selected for the purpose of protection is within the list of eligible hedged item. Similarly, we also need to see that it is eligible hedging instrument as well. So the derivative is supposed to be, because there's certain derivatives which are not considered. We're not getting into the detail of that, but they should be an eligible hedging instrument. And then third, we need to see that there is a hedge effectiveness achieved. The company is already tested that yes, if it enters into a hedge, you are able to make a good protection. And last but not the least is the concept of what is called a formal documentation. So we are able to identify, what is the purpose of carrying out the hedge. The company has to lay down the objective why it is carrying out a hedging. So what is the purpose of the hedging? What are they trying to achieve? So all that formal documentation would also get taken care. Then comes the step number 4, which is easy from an examination perspective, and that is deciding the type of hedge. So as far as the type of hedge is concerned, typically from the examination point of view, there are 2 types of hedge. One is what is called a fair value hedge, and the other one is what is called a cash flow hedge. And of course, as I said a couple of minutes back, the kind of hedge a company wants to apply is supposed to be a pure choice on the part of the company. The management may apply in a given situation a fair value hedge. Another management would feel that I want to apply a cash flow hedge. So it all depends upon, what you're trying to protect, what is the management perception. So more or less, this will be, you can say directly, indirectly, which is given in the question. And finally comes the step number 5, and that is looking at the accounting of these hedge, which I think will make a separate summary chart. So I think that creates a first summary chart in terms of hedge accounting, that if a company wants to apply a hedge accounting, get the item which you want to protect, get the instrument, the derivative with which protection would occur, ensure that you've met the criteria of hedging, identify the kind of hedge to be applied, and then finally go for the accounting or the fair value or the cash flow hedge. So let's now make a summary chart in terms of how the accounting for a fair value hedge and the cash flow hedge is applied. So let's make another interesting chart. So this is going to give us a summary chart, a mind map in terms of how the accounting is going to be done in terms of fair value as well as a cash flow hedge. So let's call this as a summary chart. So this is my summary chart in terms of understanding the accounting, the step number 5, as far as hedging is concerned. So first, let's consider how does the accounting for a fair value hedge gets taken care, and then we'll understand how the cash flow hedge accounting is done. Now, as far as a fair value hedge is concerned, in this case, we've got two things. One is the hedge item and one is the hedging instrument. And the accounting is pretty simple and straight indeed. So we've got the hedged item on one hand, and we've got the hedging instrument on the other hand. So one is the hedged item and one is the hedging instrument, which is derivative in nature. So the accounting is pretty simple and straightforward indeed, that when you consider the hedged item, it is taken at a fair value. So we will capture the hedged item at a fair value. So this will be taken at a fair value and this will also be taken at a fair value, or you can say this is going to be taken at a fair value through profit and loss account. Now, before any confusion sets in, I think let me tell you, let's say, for example, if you bring an inventory as a part of the hedging, that means you consider it to be a hedged item. I'm not going to apply Index 2. We're not going to consider the inventory at cost NRV, whichever is less. The principles of the relevant index will not apply. But you're going to consider the inventory at a fair value, and any changes in the fair value is going to be captured in the profit and loss account. So which indirectly means that once you bring any item under the purview of hedging, the normal relevance standard does not become applicable. Hedging would override the provisions of that standard. That's where sometimes many students make a mistake. So I'm just, emphasizing that point. That when you bring anything under the purview of hedge, you need to ensure that the relevant standard does not apply. So if you've got an inventory, no Index 2, fair value. If it is a PPE, no Index 16, it is fair value. And any changes in the fair value is captured in terms of P&L. Similarly, in terms of the hedging instruments, it is FVTPL. Before I'll start the practical illustrations, we'll have a look at the option, a pure derivative accounting as well. Derivatives in any case are accounted always at FVTPL. But we just need to remember that there is a small little exception. There is a small little exception to this particular concept, and that is if your hedged item is supposed to be a financial asset, which is equity investments, which is measured at a fair value through other comprehensive income, that is no recycling. It continues to be accounted at FPT-OCI. So that's the only exception, that if you've got a financial asset, equity investments, because financial asset equity investments, if they are accounted at FPT-OCI, you'll continue to account them at OCI, no FPTPL. But in this particular case, you also need to consider that even the derivative accounting will be done under FPT-OCI NR. The accounting for the derivative instruments will also not be considered under FPTPL. That's the only exception. So you can say the derivative instrument and the hedged item are by default taken at FPTPL, but with the exception, then the item, the hedged item and the derivative instruments both accounted under FPT-OCI, changes in the fair value taken in the other comprehensive income. Now let's consider the concept in terms of the cash flow hedge. How does the accounting for the cash flow hedge in this particular case takes care? So here again, we've got a hedged item as well as the hedging instrument. So I've got the hedged item as well as the hedging instrument. So here we need to be a bit careful, because when you switch over from, a particular accounting, that, previous accounting keeps disturbing you. Now, one thing is very clear, that in terms of a cash flow hedge, the hedged item continues the usual accounting. So this is not taken at a fair value, but a usual accounting in this particular case continues. So if you're looking at inventory, you continue with Ind AS 2. You're looking at PPE, you continue with Ind AS 16. So the fair value accounting is not applicable. You continue with the same accounting itself. But what you need to be a little careful on is that in this particular case, the accounting will continue, but we will still compute the fair value changes. Remember, we just need to compute the fair value changes. We don't need to account for the fair value changes. So we'll calculate the fair value changes of the hedged item to compare. This is definitely going to be recorded at a fair value. This is going to be recorded, of course, at a fair value. So we will also compute, this is going to be taken at a fair value, and we'll compute the fair value changes here also. So we will see the computation of fair value changes is going to be captured at fair value, and the fair value changes will be computed as well. Now you need to compare the two fair value changes. So let's consider this is A, and let's say this is B. So let's say this is A, and let's say this is B. Now you need to compare the fair value changes of A versus B to decide the accounting of the hedging instrument. The comparison of the fair value changes of the item and the instrument is going to be done so that you can account for the fair value changes of the hedging instrument. So if you say that A is equal to B, then the entire fair value changes will be entered in the other comprehensive income. If A is equal to B, then entire fair value changes of the instrument is going to be entered in the other comprehensive income. And if you say that A is greater than B, if you say A is greater than B, then also the entire fair value changes enters the other comprehensive income. But the only caution is that if B is greater than A, then in this particular case, we need to be careful. So in this particular case, the fair value changes to the extent of A is going to be taken in other comprehensive income, and the difference B minus A, the difference in the fair value, is going to be entered in the profit and loss account. And you know the reason that once your fair value changes of the derivative instrument is more than the fair value changes of the item, it's like taking a bigger umbrella. And therefore, it is considered to be an ineffective portion. So we know that this portion which is being taken in the other comprehensive income is supposed to be called the effective portion of the hedge. This is called the effective portion of the hedge, and the portion which enters the profit and loss account is basically called the ineffective portion of the hedge. And I always tell people that the easy way to remember this, that what is the effective or the ineffective portion, is simply to look into the simple fact. A hedging instrument is like an umbrella. And if it is raining, you should take an appropriate size of umbrella outside. So in this particular case, if the fair value changes of the item is less, and the fair value changes of the instrument is more, you're taking a bigger size of umbrella with you. That's not correct. You're allowed to take the same size of umbrella or a lesser size of umbrella, but you cannot take a bigger size of umbrella. If you're taking a bigger size of umbrella, then whatever is the excess should be accounted like a normal derivative. And therefore, the standard says that only to the extent of fair value changes of the item, you're going to take it in the other comprehensive income. To the extent the umbrella size is bigger, the fair value changes of the instrument is greater as compared to the fair value changes of the item. The bigger size umbrella, the excess size of the umbrella, is considered to be ineffective, and that is accounted the normal way, that is fair value through P&L. So that excess changes will enter in the profit and loss. Right, friends, I hope that gives us a quick recap of the concept of what is the accounting in terms of hedging. Before now we go to the practical illustrations, we'll do one illustration, as I said, on a derivative. Then I think we'll do questions on one on a fair value hedge, other on a cash flow hedge. Let's proceed. So let's, I think, take the journey forward. Let me, I think, first give you a quick inputs on a pure derivative accounting. So we'll first of all look at a pure derivative accounting in this case. So let me take a small example at my end to give you the accounting as far as a derivative is concerned. So I'll give you the facts of the case with which we can understand the accounting, let's say, for an option contract. Okay, so let's give you a very simple example. So I'm giving you an example which is based on option contract. So this is based on an option contract. So we're choosing only one kind of derivative, which is an option contract. So let's consider that on 1st January X6, let's say the company buys 100 options. Let's say the company buys a total of 100 options. And let's say these options are bought at the rate of 5 rupees per option. Let's say this is bought at the rate of 5 rupees per option. Can I say that 5 rupees per option is supposed to be, you can say, an option premium? So can I comfortably call this as a long call? What do you say?
Yes, sir.
That's right. Since you have bought an option, so I am considering that this is supposed to be, you bought an option and this is going to give you, let me also clarify that this will give you the right to buy the share. This will give you the right to buy the share of a particular company. So it is definitely a call option and you're making a payment of a premium. So this is supposed to be a long call. So this becomes a case of a long call. And you're going to get the right to buy the share, let's say on 31st December X6. So you're going to get the right to buy the share at the end of the year, December X6, and let's say for 10 rupees a share. So we will get the right to buy the share, let's say at the rate of 10 rupees per share. Okay, now we're going to look at some permutation combinations. So this is pretty simple and straight. Now I'll give you some permutation combinations to understand the accounting. I think first of all, what is coming to my mind is, a total of 3 inputs in this particular case. Can I say one is that I sell the option before the expiry date? I can do that because these derivative instruments are negotiable instruments. So one is that what I do, I am going to basically sell off the option before the contract is over. That means before 31st December, I basically sell the option. The second is I wait till a maturity date. And if I wait till a maturity date, then there are 2 possibilities which can happen. One is that I decide that I'm not going to exercise the option. Or the other one is I decide that yes, I am exercising the option. Now, if you do not exercise the option, the premium which you have paid is gone. And in the other case, when you say that yes, you will exercise, then I think there are 2 possibilities further. One is that you can go in for a cash settlement, or the other is you go in for a physical settlement. So my mind is working on a chart. The possibility is that you trade in the option before the expiry date, 1. Or the other is you wait till the maturity date, that is 2. When you wait till the maturity date, either you do not exercise or you exercise. And if you exercise, then there is again 2 possibility, and that is cash settlement or a physical settlement. So I think for a clarity of thoughts, let's look at all the permutations and combinations, what entries will be done. I think that's better. So let me, I think, create an interesting chart. So in order to understand the different permutation combinations of accounting, and this is going to be true typically in terms of the option contract, that when you're looking at the permutation combinations of the different kinds of accounting, So one possibility is that you are going to sell before expiry. So one possibility is that you are going to sell before expiry. The option is going to be sold off before the expiry date. The second is we wait till maturity. The second is we wait till maturity. That is till the 31st December, which is the maturity date of the contract. And if you say that you're going to wait till maturity, then we can say there are two permutation combinations coming in. One is that you say that, yes, I will exercise. Or I decide that I am not exercising. It is not exercised. Because since it is an option contract, so you get the option to decide that I want to buy or I don't want to buy. So on maturity, you first take a call. Are you exercising or not? Now, if you say that I am exercising, then there are two possibilities. Either we go for a physical settlement, you pay the money and you buy the shares, or we go in for the possibility of a cash settlement where you only settle the difference and you do not pay any money to buy the shares. So this is the different permutations and combinations which is coming to my mind. So again, to remind you, we're looking at only the accounting of a pure derivative contract, which is option contract in nature. The inputs which I've given you is typical only to an option contract. Okay. So I think now let's give you some data and you can help me with the accounting of that as well. So let's consider the first input that let's say on 1st of July, we sold off these options, let's say at the rate of 15. First of all, let me do the entry on 1st of January when you purchased an option contract, because these entries are subsequent entry. So here I am looking at the subsequent accounting. So here we are looking at the subsequent accounting in this particular chart. So I think first of all, let's look at the initial accounting as well. So let's look at the initial accounting, which will be done on 1st of January when you entered into the contract. So would you like to tell me that what is the entry which is going to be done on the 1st of January? When you paid a premium of 5 rupees, what entry will you do on the 1st of January?
Premium is expenses.
Premium would be expense or premium would be asset? The premium which you're paying is giving you a right to buy. So that would be a financial asset derivative in nature. So we're going to put an entry that is financial. Let's call it as option. So let's call it as option contract. Brackets, I'll call it as financial asset. This is a derivative financial asset that gets a debit and the money is paid, cash gets a credit. And this is going to be 100 options at the rate of 5. So that makes it a total of 500. So this is the entry which will be done at the inception. And just to put it clearly, that this is a derivative financial asset. This is a derivative financial asset which is to be accounted under FPTPL. Any fair value changes will be accounted in the profit and loss account itself. Okay. Now comes the input on the subsequent accounting. So when you pay the premium, unlike, let me also tell you, if it is a futures or a forward contract, there will be no entries at the very inception, because when you enter into a derivative contract, the fair value on squaring of the transaction is always 0. So no entries are done when it is a forward or futures contract, but option contract, there is only one entry which is done for the payment of the premium. So this entry takes care of the payment of premium. Now let's go ahead. Now we sold these options in the middle of the year before the maturity date. Can I treat this as a normal sale of asset? Put the entry cash account debit with the money received 15, credit the financial asset which is 10, and the difference goes in the profit and loss? Yes. It'll be treated like a normal sale of the asset itself. So the entry which we're going to do, cash or bank gets a debit. And this is going to be 15 into 100 options. The financial asset, which is derivative financial asset, gets a credit, which is recorded in the books at 10. And can I say whatever is the balancing figure at this stage that is taken in the profit and loss? So that is going to be 5 rupees per option into 100. That becomes a gain on the sale of the options. As simple and straight. Now let's look at the other possibility that you waited till the maturity date. If you waited till the maturity date, then you will decide whether you exercise or not. So let's give you some inputs whether we are exercising or not. So let's consider the market price of the share is, let's say, 8. Or let's consider the market price of the share is, let's say, 25. So we decided that the exercise price, because this 10 rupees is the value at which you can say is the exercise price. You've got the option to buy the share at the rate of 10, which is supposed to be an exercise price. So now the question is, if the price in the market turns out to be 25, you said I've got the option to buy at 10 and the price is now 25. Are you going to exercise the option?
No, sir.
If the
Sir,
market
yes,
price
sir.
is 25, the
Yes, sir.
price is pushing up bullish.
Yeah,
Yes,
because it's
I
if
will
I
exercise the option. So in this case, we'll definitely exercise the option. But can I say if the market price is 8, I'm not interested to exercise? Because why would I buy it at 10 when it is available in the market at 8? So in this case, I will not exercise. So let's see the situation. If you do
deeply out
not
of money.
yes,
Deeply out of
it is out of money, so I will not exercise. And if I not exercise, the premium is gone. So basically what you need to do at this particular stage, put the entry profit and loss gets a debit and the financial asset, which is derivative, gets a credit. So we had paid that 500 premium, that premium is gone. The premium is gone in this particular case because you do not exercise. Now let's come to the combination that you said, yes, I am going to exercise in this particular case. Now, if you say I am going to exercise, there is physical settlement and there is cash settlement. So if you're going to do the physical settlement, you will record the financial asset, that is equity investments, gets a debit. What is the value at which the equity investments will be debited? If you decide to exercise the option, so what is the value at which the financial asset equity investments will be debited? Financial assets is always initially recorded at dash fair value. So it's going to be recorded at fair value. So let's take that 100 options later. So can I say this will be recorded at 25? But the money which you're going to pay, that is equal to the exercise price, that is 10. And you will de-recognize the financial asset, that is derivative contract at this stage. And that is to the extent of the premium 5. So can I say there is still a difference of 10, and the difference of 10, can I say, is going to be taken where? We are going to take the difference of 10 in the profit and loss account, again, which is arising on the purchase of the security. So when at the maturity date, the company says, yes, I am exercising, but you go for a physical settlement, you need to capture the equity investments at a fair value, because financial assets are always initially taken at a fair value itself. And the money which is paid through the bank becomes the exercise price, and the option contract is de-recognized at this stage, and any balancing figure is a gain or loss. Of course, there will always be a gain, because an option you're exercising when there is a gain, so that gain owes in the P&L. Now let's consider that if you do a cash settlement, can I say if you're going to do a cash settlement, you will get the difference between the market price and the exercise price. 25 is the market price and 10 is the exercise price. So you're going to get the difference, that is 15. So we're going to put the entry cash or bank gets a debit, which is to the extent of 15. And then the derivative financial asset can be given a credit at this stage, that is to the extent of 5. And we can comfortably take the balancing figure, that is profit and loss, to the extent of 10. By the way, the question is that the gain which you're getting on physical settlement and on the cash settlement is equal. Is it by chance or is it got to be? You settle in cash, you settle in physical mode, so you are getting an equal amount of gain per option. By chance the same or got to be?
Sir, always same.
Yes, absolutely. And then you can keep multiplying these figures by 100. So you can keep multiplying these figures by 100 to get the answers in complete level. So this is how the accounting for a derivative contract, or you can say the options contract in particular, is done. When you pay the premium, you recognize a financial derivative asset because you paid a premium. Correspondingly, if you would have been in a short position, you would have taken a derivative financial liability in that case. Subsequently, it all depends upon, because options contract can be settled in between. They can be in American style, what you technically call. So in those cases, you will sell the options like a normal sale of the asset. And if you wait till maturity, if you don't exercise, the premium is gone. If you exercise, you decide is it physical or cash and accordingly do the entry. Right, I hope the concept of the derivative accounting is understood. Now we can come back to the
Sir,
concept of hedge accounting. Let's do some questions on that area.
sir, I have one question, sir. On the
Yes.
before expiry accounting, we have done that the financial asset crediting only for 10 rupees. Why, sir? It should be 5 rupees, right?
Which case you're talking about?
This before expiry. So
Oh,
initially we
sorry, my
regular.
mistake. Oh, yes, my error, my mistake. Thank you for the pointing that. Yes, it is 5 in the books, so you get a gain of 10. That's right. Oh, indirectly, of course, the gain in all cases, but this is, of course, by chance 10, because the prices are such that even in settlement before that. My error. You're right. This is the book value, which is 5. Correct.
Okay, sir. Thank you.
Wonderful indeed. So I think this takes care of the derivative accounting. Now I think let's take you to a question on hedge. Okay, so we've got two interesting questions on the concept of hedge. So I'll not tell you what kind of hedge is that. We'll just identify it and see it. Let's, I think, consider. I'll need that above question later. Is that visible, I guess?
Yes, sir.
Visible? Okay, wonderful indeed. So let's, I think, look at question number 19. And as I read this question number 19, we need to be very careful as we read along because this is going to give us a lot of insights. So I am given in this particular case, let me just read and then we'll just keep analyzing the data, what is given. It says on 31st October X1, Bling had inventories of gold which is costing 6.4 million to buy and which could be sold at 7.7. Can I say 7.7 is the fair value on 31st October? The cost is 6.4 and the fair value is 7.7.
Yes,
Correct?
sir. Yes, sir.
Yes, sir.
The management of Bling is concerned about the risk of fluctuations in the future cash inflow. Is that indicating anything in terms of the type of hedge? They're concerned with the future inflow, so they're worried on that what kind of cash flows will arise in the future. So what kind of hedge is he trying to hint upon?
The
Can I
cash
say
flow,
a cash flow hedge?
cash flow
That's
gets.
right. That's right. Then it is to mitigate the risk. Mitigate means to reduce the risk. Bling entered into a futures contract, and a futures contract means it is a derivative instrument. So they entered into a futures contract on the same date, 31st October X1, to sell the gold for 7.7 million. The contracts will mature on 31st March X2, which is 6 months from the date of entering the contract. The hedge was designated and documented at inception as a cash flow hedge. So he's very clearly also told you that we have taken this as a cash flow hedge. All the effectiveness criteria has been satisfied. Then he says on December X1, the fair value of the gold is supposed to be 8.6 million. And the fair value of the futures contract is also fallen down by 0.9 million. There is no change in the fair value of the gold as well as the futures contract between 31st December and 31st March. So we're given the status of the fair values on December, but he says there is no changes in the value which is between December to 31st March. Then he says on 31st March X2, the inventory is sold at the fair value and the futures contract is settled net with the bank. That means there is a cash settlement. Discuss the accounting treatment of the hedge for the year ended December X1 and outline the accounting treatment of the sale of inventory and the futures contract settlement on 31st March X2. Beautiful. I think that's a wonderful question, comprehensive one to understand the accounting for a cash flow hedge. So basically, the inputs given in the question is that you have got an inventory and you are entering into a futures contract in order to protect it. So let me outrightly ask you, what is the hedged item in this case?
Gold is a hedged item, sir.
Absolutely correct. And can I say the futures contract is the hedging instrument?
Yes, sir.
And the qualifying criteria is met, its formal documentation is done. The kind of hedge is the cash flow hedge. We just need to do the accounting. Now, in order to do the accounting, I think the best way would be to organize data. Let me not do it on this side. Let me do it separately so we can clearly see all the inputs. So I think the best way to do the accounting is to create a time scale and then organize the data. Don't be in a hurry. So first organize the data carefully. And once you organize the data on a time scale, then start looking into the inputs, what is given. Then we'll do the accounting. So let's, I think, pick up the data one by one. So I am given my financial year is ending on December and I entered into the contract on October X1. So let's organize the dates. So my financial year is ending on 31st December X1. So it starts on January X1. And I'm given that on 1st October X1, we've entered into the futures contract. And I'm also given that this contract is going to be settled on 31st March X2. So let's just pinpoint. So this is the, you can say, date of entering. This is the date of entering futures contract. Just noting down the data. This is supposed to be your balance sheet date. And this is supposed to be the date of settlement of the futures contract. This is the date of settlement of the futures contract. So we've got three focus points in the question. One is when you entered into the futures contract, one is the balance sheet date, and one is the date of settlement. Now let's pick up the information. It says on 31st October, the company had inventory costing 6.4, which could be sold at 7.7. This is 31st October. So I am given the status that we've got inventory and I'm given that this inventory has got a cost to the extent of 6.4 million and it has got a fair value, which is it can be sold at 7.7 million. So I'm just noting the data for the time being. And then it says further, the management is concerned about the risk of fluctuations in inflow. Therefore, they entered into the futures contract to sell the gold at 7.7. So they entered into a futures contract and this was to sell the gold. It says at the rate of 7.7 million. So this is the rate at which they've entered into a derivative contract.
Which means the short call?
No, you can't use the word call in this case. It's a futures contract. So you can only say that you're selling futures. It's not option.
Okay.
Then it says further that the contract will mature on 31st March. We've taken a note of that. Effectiveness criteria, everything met. So. On 31st December, the fair value of the gold is 8.6 million. So now we're given the status that the fair value of the gold. So the fair value of the gold at this particular stage has become 8.6 million. And he's also given me the status of, after the fair value of the gold, the fair value of the futures contract fallen by 0.9. So futures contract, there is a decrease of 0.9 million. So we're just segregating the data. This is the data for the inventory, and this is the data for the futures contract. Okay, so let's take the data further. And then it says there is no change in the fair value of the gold and the futures contract between December and March X9, X2. And so now he gives me the information that the fair value at this particular stage is also same. And the status of the fair value change is also the same. So there has been no changes in the fair value during this particular quarter. The fair value of the gold is 8.6 and the fair value decrease is constant at 0.9. And then it adds on further that on 31st March X2, the inventory is sold at the fair value and the contract is settled. So this is a date when not only the date of settlement of the contract is done, but it is also the date of sale of inventory. So two events have happened. Two events have happened on 31st March. The company is going to sell off the inventory at a fair value and the futures contract is settled net of cash. Okay, so I think I've organized the data. I hope you're very clear with the organizing of the data. It's very important that when the question gets a little complicated, just organize the data very well, and then we can concentrate on the typical dates of the entry. Right, so far so good. Are we clear with the organizing the data?
Yes, sir.
Yes, sir. Clear, sir.
Wonderful indeed. So now let's begin with the picture. Now what I am going to do, I am going to concentrate on 3 dates of accounting. My focus number 1 is the date when you entered the contract. My focus number 2 is the balance sheet date. And my focus number 3 is the date of settlement and the sale of the inventory. So we're going to see what entries are done at each date. So let's, I think, begin with the entries. So first, I think, pinpoint once again, can I say this inventory is supposed to be the hedged item? And this futures is supposed to be, you can say, the hedging instrument.
Yes, sir.
So that is like my step number 1, and that is like my step number 2. Then my qualifying criteria is already met. It is very clearly stated in the question. And my step number 4 is that I'm using a cash flow hedge. So I'm only concentrating in terms of accounting. Now let's begin. It's not an option contract, but it is a futures contract. So as I said, if you settle the futures contract on the date when you enter the contract, the net gain loss is always 0. So there is no entries which are done on October X1. So on October X1, there will be no entries to be done in the books of accounts. Now let's see what are the entries to be done on 31st December X1. Now, if you recall the concept of a cash flow hedge, we will distinctly remember that as far as the hedged item is concerned, the usual accounting would continue. So just to be on a fair side, let me ask you, are you going to continue to record the inventory at 6.4 as per Index 2?
No, sir.
If you've entered into a cash flow hedge, are you going to continue the inventory recording at 6.4 itself?
No, sir. We should account as a fair value, sir, because we are.
I just, made a mention very clear cut. I'm just taking you back on the agenda. Let's please have a look at this. This is most important chart which I have created. If it is supposed to be a fair value hedge, the item and the instrument both are captured at a fair value. I repeat. If it is a fair value hedge, the item and the instrument both are recorded at a fair value. The basic principle of the relevant standard gets overridden. I will not apply Index 2. I will not apply Index 16. I will capture the item at a fair value in a fair value hedge. But in terms of the cash flow hedge, the usual accounting will continue. I will compute the fair value changes to compare it and decide the accounting of the instrument. I will compute and compare it to decide the accounting of the instrument. But as far as the item is concerned, usual accounting. That's the key issue. I hope I'm clear. That's why I started with a fresh mind, hedge accounting in the morning.
Right, sir. In case of fair value, we will do it the fair, right. In the cash means,
Absolutely.
yeah. In case of cash flow, then we have to use the usual accounting for the hedged
Yes.
item.
Right. But we'll just compare the fair value changes of the inventory versus the fair value changes of the futures contract to see how the fair value changes of this future will be accounted. What portion will be taken in the P&L? What portion will be taken in the other comprehensive income? So let's now consider. So can I say as far as inventory, just to be on the safe side, the inventory continues. The inventory continues at 6.4 million. There is no change. Ind AS 2 would apply. Now let's make a calculations carefully on this. Can you tell me what is the fair value change of the item? We need to calculate the fair value change. So please don't compare 6.4 versus 8.4. You're not supposed to compare 6.4 versus 8.6. We need the change in the fair value. So can I say what is the change in fair value? Is it 0.9? That is the change in the fair value of the item. And the fair value change of the instrument is also 0.9. So as I said in the chart, you need to compare the fair value change of the item versus the fair value change of the instrument. They're both 0.9. Can I comfortably take the entire change in OCI, call it as an effective portion, umbrella size is perfect in nature? Yes. So in this particular case, we'll take the amount in the OCR. Now the question is that when you're looking at the futures contract, is this supposed to be a gain or is this supposed to be a loss for me when you're looking in terms of the fair value fall? You made a sale of the futures contract. So if the value falls, can I say in this particular case, is this a gain or is this a loss?
Sir, it is a gain, sir.
No, 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 it's not a gain. There is a fair value fall. So when you entered into to sell it, so basically you are now saying that the value has gone down. So it's a loss to me. So if there's a loss to me, I will debit my other comprehensive income. And correspondingly, you can create a financial liability in this particular case. So financial liability, brackets, I'll put down, derivative gets created. This is to the extent of 0.9 million. A fall would mean a loss. And let me also tell you one thing. Anytime you get a confusion, there is one simple basic concept which you can apply. If there is going to be a gain on the hedged item, can I comfortably say there will be a loss on the hedging instrument? Do you agree? A gain on the item will always equal the loss on the hedging instrument. It has to be in the opposite directions. So you can see that the fair value of the inventory, which is the item, has gone up. You're getting a gain on the item. So 100% you're going to get a loss on the hedging instrument and vice versa. The gain or loss may not be equal, but one thing is always there, that if you're getting a gain on the item, you'll get a loss on the instrument. If you're going to get a loss on the item, you're going to get a gain on the instrument. Correct. Okay, so this takes care of the entries on December X1. The inventory continues and we have captured the fair value changes. Now the question also is, where would this amount in other comprehensive income enter? Can I say this will be accumulated at which place? So key. And that's in tab number 3. And this will be given a special name, and that is called a cash flow hedge reserve, CFHR. So this is going to be accumulated. This is going to be accumulated. This is going to be accumulated in statement of changes in equity, that is so key, in terms of tab number 3. And this will be given a name that is called a cash flow hedge reserve. This is going to be given a name that is called a cash flow hedge reserve. In short, we call it as CFHR, that is cash flow hedge reserve. Is it a case of R or is it a case of NR? The amount which you've taken in the other comprehensive income, is this R or is this NR?
Or sir, in case of
That's
equity,
right.
equity means NR.
Yes, so this is going to be a case of R, it is a case of recycling. So what we're going to do with the CFHR, once the sale of the hedged item takes place, once the sale of the hedged item takes place, we go to transfer this in the P&L, which means on 31st March X2, this accumulated balance in CFHR is going to be taken in the profit and loss account when the hedged item enters the profit and loss account. Okay, now let's see the entries on 31st March X2 when we have made a sale of the inventory and we've also settled the futures contract as well. So let's, I think, first of all, look at the entry sale of the inventory. He said the inventory is sold at the fair value, which is 8.6. So let's look at the entry for sale of the inventory. So it can be cash or account receivable as the case may be, depending it's a cash sale or depending it's a credit sale. So you get a debit for cash or a account receivable and you capture the sales, and this is going to be recorded at 8.6 million. That is the sale of the inventory. Now, once you record the sale of the inventory, you also need to capture the cost of sales as well. So let's also put the entry that is cost of sales gets a debit and the inventory gets a credit. And this is going to be to the extent of the cost, which is 6.4 million. So these are the entries which are done with reference to sale of the inventory. So sale is done and the corresponding cost of sales also gets captured. Next, we now need to settle the futures contract. So in this particular case, when you do the futures contract settlement, it very clearly says that you're going to do a net settlement in this case. A net settlement in this case will mean what? Are you going to get money or are you going to pay money? So first of all, let me also tell you, there is no change in terms of the fair value of the hedging instrument as well as the hedged item. Otherwise, on 31st March, I would have again compared the fair value change of the hedged item versus the fair value change of the hedging instrument, and I would have taken the difference depending is it effective, ineffective in the P&L and the OCI. Since there is no fair value changes which are there, so nothing needs to be captured at this stage. So we just need to do a net settlement. So are you going to get money or are you going to pay money? There is a derivative financial liability. So you're going to pay money or get money. I think I'll have to answer that as well. I'm going to pay money. So the entry in this particular case is financial liability derivative gets a debit and the cash or the bank gets a credit. So this derivative liability of 0.9 million gets settled in terms of cash. And the only other entry to be done now is the balance in the accumulated balance in SOKI, that is CFHR. So can I say the CFHR has got a debit balance? So what I need to do at this stage, put an entry, profit and loss account debit, and the other comprehensive income gets a credit. So this amount of 0.9 million, which is accumulated in the SOKI, will get transferred in the profit and loss, because when you sell the inventory, the hedged item enters the P&L, and now the accumulated balance can be transferred in terms of P&L. Right, friends, I hope I am pretty much clear. This is quite a comprehensive question dealing with the concept of a cash flow accounting. I intentionally did not do any question on a fair value hedge because fair value hedge is simple. You just capture the fair value changes of both item instrument, put it in the P&L with one exception. There's nothing great in that accounting.
So kindly explain this 0.9 millions in the OCI.
Okay, I'll do that. Okay, so first of all, I think we'll give you a little extended version as well. Now, one thing what we need to remember, every time the fair value changes of the instrument is captured, every time the fair value changes of the instrument is captured, you will take a portion in OCI or maybe the entire portion in OCI. Now, whatever money is taken in the OCI will keep accumulating in statement of changes in equity in tab 3. That's what Amir mentioned. I hope till this stage we are clear.
So this is clear. The how I'm asking about the 0.9
Yes.
million in the OCI entry, how it is debited.
I'm just coming to that. Okay, you mean to say that why did I debit this amount?
So that only that part.
Okay,
Yes.
only that part. Okay. Now, you need to be, first of all, clear on the fact that there has been a fall. If not that, let's consider like this. I'm going to give you a statement, just vouch me. Can I say if there is a gain on the inventory? 100% there will be a loss on the derivative. Agreed?
Yes, sir.
Correct. So now let's look at the inventory. Can I say inventory, the fair value goes up? There is a gain on the inventory.
Yes,
So if
sir.
there is a gain on the inventory, definitely this means that this point 0.9, which is the fair value change, is a loss on the derivative. Correct?
Okay, sir. Correct,
So
sir.
because it's a loss, the loss
Yes,
is
sir.
going to be captured in the OCI, because
Yes, sir.
a cash flow hedge, we said the fair value change will be captured in the OCI P&L depending effective and ineffective. But since the fair value change of the inventory is 0.9, the fair value changes of the derivative is zero point 0.9, the entire amount is taken in the other comprehensive income. Being a loss, it gets debited in the OCI.
Thank,
Correct?
thank you, sir.
You're welcome. Right. But there is another interesting point due to which I put another question as well. There's one more agenda which is there, due to which I have put another question as well. So let's, I think, do one more question with you on the concept of a cash flow hedge. So let's, I think, look at the question number 20, which is also dealing with the concept of a cash flow hedge. Let's have a look, but there is a slight little difference, and I thought let's do this question as well. It says in January, Greaton, whose functional currency is dollar, decided that it is highly probable that they would buy an item or plant in 1 year's time. Is this an unrecognized asset in the balance sheet as of today? They are planning to buy
Yes,
the asset in 1 year's time. Is this an unrecognized asset? Is that an unrecognized asset? Yes, of course. Did I tell you that technically, if you've got a firm commitment, generally we apply a fair value hedge. And if it is supposed to be a forecasted transaction, highly probable, generally we apply a cash flow hedge. And therefore, you'll see that in this particular case, we'll end up applying a cash flow hedge. It says as Greaton risk is risk averse, it wished to hedge the risk that the cost of buying the KRs would arise, and so entered into a forward rate agreement, that is derivative. To buy, it says 2 lakh KR in 1 year's time for a fixed sum of $1 lakh. The fair value of this contract at the inception is zero, and that's always zero. And it is designated as a hedging instrument. So the forward rate contract is the hedging instrument, and the unrecognized plant is supposed to be, you can say, the hedged item. It says at Greaton's reporting date, which is 31st July, KR had depreciated and the value of 2 lakh KR is changed to $90,000. The fair value of the derivative declined by $10,000. And these values have remained unchanged until the plant was purchased. But I'm not given the date when the plant is purchased. Then he says, how would this be accounted for? Did he anywhere make a mention that this is supposed to be a fair value or a cash flow hedge? No. But isn't the concept that it is a highly probable forecasted transaction indicative that I am supposed to apply a cash flow hedge? Yes. Right? So I think let me just organize the data out here on the right hand side itself and solve this particular question. So that's not a very big question indeed. So we'll solve it here. This was question number 18. Sorry, question number 19. This was question 19. And we are on question number 20. Okay. So let's again, first of all, organize the data before we proceed further with this. So I am given my reporting date is 31st July. My reporting date is 31st July. So when does it start? Can I say 1st of August? My financial year will be starting on the 1st of August and it is ending on 31st July. Now let's read the input. Let's organize the data. It says in January, Greaton, whose functional currency is dollar, decided to buy a plant in 1 year's time. So this was in January. So I'm given the date of transaction is supposed to be January. So this is my balance sheet date, and this is the date of settlement, which is not given. Three focus points again: the date of entering the contract, the balance sheet date, and the date of settlement. I think in this case, let's take your inputs as well. Previous question, I think I did it complete. So let's, I think, take your inputs as well. So let's organize the data. So in January, the company decided that it'll buy an item of machinery, and then it is risk averse. So they entered into a forward rate agreement. So we entered into a forward rate agreement, FRA. And this was to buy 2 lakh KR. This is to buy, it says KR, that is 2 lakhs. In 1 year's time, for the fixed sum of money, which is $1 lakh. So you're going to buy KR, it says at the rate of $1 lakh. That is the price at which we'll buy. And then it says the fair value of the inception is zero, blah, blah, blah. At the reporting date on 31st July, the KR had depreciated. And now on the balance sheet date, that KR 2 lakhs is as good as, it says, $90,000. So it has come down and depreciated at 90,000, and the fair value of derivative is declined by 10,000. So we are given that there is a decrease in the derivative value. So there is a decrease in the derivative value by $10,000. That's, I think, visible enough. 1 lakh to 90,000, 10,000 decline. And these values remain unchanged. So can I say there has been no change, just like the previous question, there has been no change in terms of the balance sheet date till the date when the plant is purchased, or you can say the forward contract is settled. Right, that's it. So how should this be accounted for? So let's, I think, begin the journey. So let's, I think, begin the journey on January. Will there be any entries on January? Are you going to put any entries on January when you entered into a derivative contract? It's forward in nature. It's not an option contract.
No, sir.
That's absolutely correct. So can I say in this particular case on January, there will be no entries done? Because in terms of forward and in terms of the futures contract, we are not supposed to do any entries at the initial. It's only in terms of option that you put an entry recording the premium. Now let's come to the balance sheet date. In terms of the balance sheet date, are you going to capture the fair value change of the plant in this case, which is highly probable transaction? Remember, this is a cash flow hedge. Are you going to capture any fair value changes of the unrecognized asset in this particular case? No, of course, no. Reason, we do not do any accounting. It's a usual accounting done. So we're not supposed to capture any fair value changes as far as the hedged item is concerned. Now let's concentrate on the derivative. Now you tell me, is it a gain or a loss? The derivative has fallen down.
Sir,
Is
it is
that
a
a
gain.
gain?
It's a gain, sir.
No. It's not a gain. It's a loss. Your derivative value has gone down in this particular case. So it has gone down. It's fallen down. Previous question also said it fallen down. So that's a loss to me. So where will you debit this loss? Other comprehensive income, because it's a cash flow hedge. And
Yes, sir.
this is going to be a financial liability. Let's call it as a derivative financial liability. And that is to the extent of $10,000. Because a functional currency is dollar. So we're recording this at $10,000 itself. Okay, now we go on to the next entry in this particular case. Now, let's considering the settlement date. Are you going to record any fair value changes at this stage? There has been no changes in the fair value. So are we doing any accounting at this stage? No. There is no fair value changes, so no derivative changes to be recorded. The only thing is that now we are going to record the purchase of the plant and we are going to settle the derivative as well. So let's now do the entry for the purchase of the asset. Now, what is the normal entry for purchase of the asset? Can I say PPE gets a debit and the cash is going to get a credit?
Yes,
Now, the
sir.
only question which, yes. Okay, now the only question which is coming to the mind is, can I say I am going to first of all settle a derivative in cash and buy the machine as well? So let's do the two separate entry. Can you tell me for the derivative liability, are you going to get money or are you going to pay money? It's a liability. Are you going to get money or are you going to pay money? It's a liability. I've already given you the hint.
Yeah, we need to pay the money, sir.
That's right, absolutely. So financial liability, that is derivative, will be settled. So we'll pay the money, that is bank. This is to the extent of 10,000. And then you buy the plant as well. And can I say the plant is going to be bought at $90,000? PPE gets a debit and the bank gets a credit. And can I say this is to the extent of $90,000? So the settlement of the liability is done and the purchase of the plant is also done. Next, what do we do with the CFHR, the accumulated balance in tab 3? I'll tell you, or you can tell me if you want. What will you do with this accumulated balance in OCI? Can you put it in the P&L account at this stage? Is this amount which is accumulated in CFHR, can I put it in the profit and loss account at this stage? I think let me answer that. You cannot. If you remember, I said the hedged item, when the hedged item is taken in the P&L, it is at that stage the balance in the CFHR is entered in the profit and loss account. Is this plant going to enter the P&L on the date of purchase, or is it going to be taken in the P&L over a period of time when you're going to consider depreciation in the P&L?
Over period of time, finally at the time of sale.
Right. So not exactly. You can say it's going to be depreciated year by year. So can I say the plant will enter the P&L over life of the asset? So in this particular case, the standard says that this amount is going to be adjusted to the PPE itself. So can I say when you go to adjust the PPE, it is called a basis adjustment. Because when you're going to make the adjustment to the PPE, automatically the PPE value in this particular case will increase. Can I say it will increase, which means you're going to get more depreciation every year. So indirectly that CFHR is getting debited to the P&L in the form of enhanced depreciation. So what we're going to do in this particular stage, apart from this, the amount which is in the OCI, we'll put the entry PPE gets a debit and the other comprehensive income gets a credit, which is to the extent of $10,000. So what is to be taken caution in terms of a cash flow hedge is the accumulated balance in CFHR is supposed to be transferred to the P&L when the hedged item enters the P&L. In the previous example, it was inventory. And inventory enters the P&L in one shot. Because inventory is supposed to be entered in the P&L the day it is sold. So it enters into one go in terms of P&L. But when the hedged item is something like, a depreciable asset, then the amount in the accumulated balance in SOKI cannot go to the P&L in one shot. So instead of transferring that amount in the P&L on the date of purchase, it is adjusted against the PPE value itself. So this will enhance the value of the PPE and automatically the depreciations will increase over the life of the asset. So this amount is indirectly getting debited to P&L over the life of the asset. So either the CFHR enters the P&L in one shot, or the CFHR enters, you can say, the value of the asset, gets adjusted in the value of the asset, and automatically it gets spread over a period of time. That was the intention of taking this particular question. Right, friends, so far so good. So I hope you're all comfortable with the concept of hedge accounting. I've spent a good time in terms of hedge accounting, the cash flow hedge, the fair value hedge, and all the permutations, combinations. Comfortable with it, I guess?
Yes, sir.
Wonderful indeed. Now I think let's take the journey forward. So we've done a quick revision on the concept of hedge and also done practical illustrations with you on the concept of hedge. Now I'm going to take the journey and we're going to go to the next concept, that is impairment. So let's take a revision on the concept of impairments now with you. So let's, I think, talk in terms of impairment. We'll do a quick revision of the concept, then do some questions on the concept of impairment. Now, this is easy again as far as the concept is concerned. Of course, practical life will have its own challenges in terms of impairment. But of course, from the examination point of view, it's not that complicated affair. Now, let's, I think, consider the inputs on impairment. What happens, I have seen generally, what happens is that, when students are studying the concept of financial instruments, by the time, they reach the point where we are coming to the last stage of the financial instruments, they said, oh my God, this is too enough for me to handle now. Studied too much in terms of financial instruments. So by the time you come to, derecognitions and the concept of impairments and hedge accounting, the focus point gets a little lesser on that. That's what I've seen as a general tendency. And then, when you start looking at the frequency in terms of the paper, you see, okay, this has not got a great frequency as well. So, let's not spend too much time. But I feel, especially when you get MCQs, the scope intensifies, because when you're getting MCQs in the exam, very interesting MCQs can be drafted in terms of hedge accounting. The examiner could just test you that when you are getting a fair value change in a cash flow hedge on the derivative instrument, what is the effective and the ineffective portions? So all those things can be tested, and MCQs can be very, very scoring affair. So especially with the concept of 30% devoted to MCQs, I think one should definitely spend a good time on each and every aspect, because that 30 marks is a good scorer. And if you get the 30 marks, I think you definitely pass the paper, because I think getting that another 10 marks is not a big problem at all. Then I think you're working towards a goal of getting good marks as well. Okay, so let's now begin the journey in terms of impairment of financial assets. So let's make a quick summary chart understanding the aspect of impairment in a simple summary chart. So I divide this entire impairment process again in terms of a simple three-step model again. Back to the three-step model from a five-step. So when you're conducting an impairment, the first is you need to see that the given asset is within the scope of the standard Ind AS 109. The second is, once you've identified that it is within the scope of the standard, the second agenda is to identify that what kind of impairment testing, which approach are we using, because you know that there are two approaches. One is called a general approach and the other is called a simplified approach. So depending upon the nature of the asset, you'll zero down in terms of which approach to be followed. And the third, of course, is getting the amount of impairment loss. So the three steps which you need to apply: step number 1, step number 2, and step number 3. So let's call this as a summary chart again. I'm not getting into details on the concept because we're doing a revision. So I am going in order of first, giving you a quick revision of the concept and then doing some practical illustration so that revives the knowledge, and then we can just, keep practicing. So in terms of the step number 1, the idea is to look at the scope of the standard, that whether the given financial asset is within the scope of the standard or not. So I would segregate all the financial assets, as you know, in terms of debt investments and in terms of equity investments, and they are measured at different base. So let's give you the list and ask you which one is within the scope, though we made the chart earlier as well. If you remember, I gave you a summary chart in terms of financial assets. So we've got debt investments, and we've got what is called equity investments. And we know, as far as debt investments are concerned, they could be measured in three broad categories. The debt investments could be at amortized cost or fair value through other comprehensive income, which is recycling, or it is a fair value through profit and loss. And when it comes to the concept of equity investments, it is either taken at a fair value through P&L, or it is taken at a fair value through other comprehensive income, which is always with a no recycling. So let's put some quick questions to you on these different permutations and combination category. Can I outrightly say that as far as equity investments are concerned, no impairment testing is conducted? As far as equity investment is concerned, can I outrightly say that they're not under the purview of impairment testing? Agreed? I thought I'll get a quick answer on that based on the chart which we have done on financial assets earlier. In that chart, also, I gave you, do you conduct any impairment testing in terms of equity investments? No. I hope, friends, you remember there is no impairment testing which is conducted on equity investments, even if they're carried at a fair value through OCI. I think a little word of caution at this stage. When you look at equity investments at FPT OCI and it is with a no recycling, the standard setters are a very important thought process. Nothing in terms of equity investments will enter the P&L. The unrealized gains or losses goes in the OCI. That is the fair value change. The realized gain or loss arising on sale of investment goes in the OCI. So at the end of the day, whether it's an unrealized gain loss, OCI, whether it's a realized gain loss, it is OCI. So they wanted to protect that even if it is impairment enters the P&L. So they said, no, we are not going to put anything in terms of profit and loss. So equity investments at OCI are outside the purview of impairment testing. But debt investments in OCI are certainly within the purview. Let's put some quick questions again. Is amortized cost debt investments within the purview of impairment?
No, sir.
A C is yes. If you remember, I'd given you the chart on financial assets in which I gave you one particular row which said impairment. And I think if you remember, debt investments AC, yes. Debt investments OCI, yes. FPTPL is a no because they're already at a fair value through P&L. Equity investments, a big no. So this AC is yes, OCI is yes, but FPTPL is no.
Yes,
That
sir.
is one thing you need to be careful on. So I hope I'm clear on the first step. So
Yes,
you
sir.
need to first of all see that the financial asset is a debt or equity investments. If it is equity investments, a big no. If it is debt investments, only two cases, AC, OCIR. Then we go to the second step. The second step is deciding the approach. The second step is deciding the approach. And we know that there are basically two approaches, though there are three, but we look at only two approaches from the exam point of view mainly. One is called the simplified approach and one is called the general approach. Though there is another approach also which is called a POCI, a purchase originated credit impaired asset. When you purchase assets which are credit impaired at the very inception, that's a different ball game altogether. So in this particular case, we've got a general approach and we've got a simplified approach. So you also know something, let me just add on to that input, that when you consider a general approach, in general approach, what you need to do a credit risk assessment. In a general approach, you need to do a credit risk assessment and see, is the credit risk assessment, is there a significant change in the credit risk from the inception till the balance sheet date? But when it is a simplified approach, a credit risk assessment is not required to be conducted. So the difference between the two approaches is that in a general approach, a credit risk assessment is conducted in a general approach, but a credit risk assessment is not conducted in a simplified approach. In a general approach, when you conduct a credit risk assessment, you need to see that is there a significant change in the credit risk or not. If there is no significant change in the credit risk, you'll end up using a 12 months ECL. And when there is a significant change in the credit risk, you'll end up using a lifetime ECL. So depending upon the credit risk assessment, when you reach a conclusion based on this, that is there a significant increase in the credit risk, let's call it as SICR, that we identify that is there a significant increase in the credit risk. If you say no, there is no significant increase, then you'll end up using a 12 months ECL approach. And if you say yes, there is a significant increase in the credit risk, we'll end up using what is called a lifetime ECL approach. So in any case, the significant increase in credit risk is not assessed, but that's more or less always straightforward given in the question. In the examination, the credit risk assessment part would be given. So you would read the question and see that is there a significant increase happening? If no, a 12 months ECL, otherwise a lifetime ECL. And in terms of a simplified approach, it is always a lifetime ECL. There is no concept of a 12 months ECL in this particular case. The expected credit loss is always a lifetime. But we also need to carefully remember that, which financial asset, which particular approach would apply. So by default, it is always a general approach. But then if you've got account receivable, provided they've got no significant financing component as per India's 115, we apply a simplified approach. So you can say in terms of the default, so we can say the general approach is supposed to be the approach by default. But when it comes to a simplified approach, typically applicable if you've got account receivable debtors without significant financing component. Without significant financing component. So in those particular cases, the standard allows you to use a simplified approach in that particular case. So we'll end up using a case of a simplified approach when there is an account receivable. So more or less you can say that a simplified approach applies for an account receivable when there is no significant interest element. Otherwise, by default, we apply a general approach. That is step number 2. Now, we come to the step number 3, which is the core part of computation. Which is the core part of the computation of the provision. So what is the amount of provision to be created? What is the allowance to be created for the expected credit loss? And in this particular case, we apply the concept of considering EAD into LGD into PD into TVM if applicable. So 4 factors goes in the calculations of the amount. So EAD is the exposure at default. EAD is the exposure at default. So basically the book value of the financial asset itself is the exposure at default. Because you are exposed to a default, let's say for the principal amount of the loan. So there is a loan which is given as a financial asset, then the loan amount itself is the exposure at default. And then we consider what is the loss given default. What is the loss given default? So say for example, when you give a loan to someone, then you know that you've got some kind of security and that security has got a realizable value. So in this particular case, let's say the loan is given for 20 lakhs and you've got a security which is realizable at 15 lakhs. So which means that out of 20 lakhs, if anything goes wrong, you'll recover at least 15 lakhs, 75%. So the remaining 25% is the loss given default. So we will create a provision not on 20, but you can say on 25%, that is 5 lakhs. And this PD is supposed to be the probability of default. Because we are not going to create a provision based on the total amount, but we'll see what is the chances of a default happening. The probability of default, of course, is given in the question itself, because based on the credit risk assessment, you would come to know that if you're using a lifetime or a 12 months ECL, then what is the PD for that lifetime or a 12 months ECL? And this is the time value money, which is going to be used only if relevant. So time value money will be used only when it is relevant in nature. So multiply the 4 factors and you are able to get what is the provision to be created for the ECL. Let's connect the dots. Then I think we'll take a break and then we'll do questions on this. So when you're looking at the concept of impairment, you need to process your mind that you're going to go on a 3 steps attacking the question. At the first instance, what you need to do, you need to see that is the given financial asset within the scope of the standard. So get it very clear that you're looking at a debt investments at AC, a debt investments at OCI within the purview. If it is equity investments, no, irrespective of the measurement base. If it is a debt investment, FPTPL, no. The second input is to zero down the approach which we are applying. By default, you can say it's a journal approach always, except that if you've got a financial asset which is account receivable, which has got no significant financing component as per India's 115, then you'll end up considering a simplified approach which does not require any kind of credit risk assessment. And in this particular case, a lifetime ECL is applied. But if it is a case of a default approach, you need a credit risk assessment, and the question will tell you whether the credit risk is significantly increasing or not. If there is a significant increase in the credit risk, you'll end up using a lifetime ECL. And if you're using the concept of no significant increase, then a 12 months ECL, and you get the PD, the probability of default, accordingly. Then just create a provision for the allowance, the provision for ECL, the amount of the financial asset, EAD, into the loss given default, what is the maximum loss which could occur after considering the security realizable, into the default probability, and then also consider time value money if it is relevant in this case. So I hope the summary is clear. Now we can do questions on that, but I think first we'll give you a small little break, 10, 12 minutes, and then we'll start the journey doing some questions on this area. Right, friends. So I think let's take a break, relax your minds before we do the question. Enjoy your
Thank you,
break.
sir.
Thank you.
Right, sir. Thank you, sir.
Had a relaxation of mind. Now, I think let's have a look at some questions on the concept of impairment. So, I'm going to start with a very simple example and then I think add on a little complicated one as well. So, let's give you a first example. Let me give you the data. So, we'll apply the simple three-step model in terms of answering this particular question. So, let me just give you the inputs. Let's consider the entity has got a debt investment. Let's say the company has got a debt investments which is measured at fair value through other comprehensive income, of course implies R. Now let's say this is purchased on the 1st of January X1 at 1000. And let's consider that the interest rate on this particular investment is equal to the effective interest rate as well. And let's consider this is, okay, what will be the rate? Let's consider that, okay, let's consider 10%. So let's consider this is 10%. And then let's also give you the position of the book value on December X1, and that is to the extent of 1000. So this is the book value, and I'm also given the status of the fair value on December X1. The fair value is supposed to be at the end of the year, let's say 950. And then I'm also given the input that there has been no significant credit risk increase. So I've written at SICR, no significant increase in the credit risk. And therefore, the company would land up using a 12 months ECL. The company would land up using a 12 months expected credit loss. And let's say the expected credit loss is also given to me. The amount of ECL is 30. Simple and straight indeed. So I think let me just pinpoint the data. It is a very simple question to start with. Then I'll give you a little more complicated one. So the company is basically got a debt investments which is measured at FPTOCI. So we're given the value at which it is purchased at the start of the year. The contracted and the effective rate of interest is same. So the book value at the end of the year is same as at inception. And we're also given the fair value at the end of the year. And there is a 12 months ECL because there is no significant increase in the credit risk. And we're given the amount of the provision already in the question. So my focus is only to do the accounting. Now, let's begin with the question number 1 to you. First of all, if I apply my step number 1, is it within the scope of Ind AS 109? What do you say?
Yes, sir.
That's right. It's a debt investments at OCI. So it is definitely in the scope of the standard. Next, which approach are we using in this particular case? It's not an account receivable. A general or a simplified approach. It's not an account receivable. So which approach?
General by default.
General.
Absolutely, a general approach by default, which means you need to carry out the significant increase in credit risk test. And it's already given that there is no significant increase in the credit risk. Therefore, a 12 months ECL is applied. Then we go to the step number 3. Am I already given the amount of allowance or the provision to be created? Yes. The amount of provision is already given 30. Now, I want you to give me a journal entry which I would pass. So let me first of all tell you one more thing before you give me the entry in this case. If I were to visualize the ledger account of this debt investments, let's say I make a financial asset account. Can I say at the inception when you purchased it at 1000, that also indicates indirectly the fair value? I'm assuming that if the interest rate and the effective rate is same, That means it also means there is no processing fee, there is no transaction cost. So I'm also going with the input that transaction value and fair value is same. So you would have recorded this at 1,000, and can I say you would have taken a finance income of 100, correct? And then you would have also received a contracted rate of 10%, that's 100. And the balance CD in this case, if you take a balancing figure, is 1,000. Can I say that is applicable for amortized cost approach, correct? Because when you take a balance CD, then the balance CD is supposed to be taken in AC. But if it is OCI, you need to take the fair value. So this balance CD technically should be taken at a fair value, which is given 950. So where will you take this difference of 950 ideally to? Forget about the concept of impairment. If there is a balancing figure in the financial asset at OCI, where are you going to capture the difference between 1,000 and 950?
OCI.
Debt investments, OCI, that's right. But can I say, I am now given the input. So you have to give me the entry. I'm just organizing the data for you. So can I say the book value is 1,000, the fair value is 950. So we know the difference is to the extent of 50. But can I say out of this 50, 30 is due to impairment. So what do you think? How much should go to the OCI and how much should enter the P&L because of impairment loss? Out of the change of 50, how much enters the P&L? How much enters the OCI?
Sir, P&L it will go to 30, 20 it will go to OCI.
Wonderful indeed. Since there is a total fair value change of 50, if there was no impairment, we would have taken that entire 50 in the OCI. But since out of that 50, 30 is an impairment loss. So my journal entry, if I were to do a journal entry at the end of the year, we can say it is OCI gets a debit, profit and loss gets a debit, and the financial asset debt investment gets a credit. So the amount of fair value change is 50. So decrease it. Impairment is 30. So the remaining 20 enters the other comprehensive income. So in this case, we didn't have to compute anything. The provision for the allowance was already given. We were just focusing on the accounting entry to be done at the end of the year when there is an impairment recording. So far, so good. I hope that is clear. Okay, so I think let's take a little more complicated question with you now. This was very simple and straight indeed. I think let's take you to a little more interesting question. So let's give you another example, in which case we'll have to do computations as well. So let me organize the data. In fact, this question which I did with you is one of the similar questions which has come in the revisionary test papers as well, where the amount of provision was very clearly given in the question, except that the examiner was interested in looking at, do you know what amount goes in P&L and what goes in OCI? Okay, let's now give you another input as well. Let's say on 1st January X1. So let's say on 1st January X1, a company buys a bond. A company buys a bond. And let's say the company bought the bond, let's say for a total of 10 lakhs. So they bought the bond, let us say for 10 lakhs, and this bond is measured at AC. It is measured at amortized cost, that is AC. And let's also consider that the interest rate and the effective rate is same. So the interest rate is equal to the effective interest rate. And let's say this is 10%. And let's also consider that the payment of the interest is annually, is going to be paid annually in arrears. And as far as the principal is concerned, it's going to be paid, the principal is going to be paid on December X3, which means after 3 years' time. So interest is paid every year and the principal is paid at the end of third year.
Bullet payment.
Yes, it's a bullet payment, exactly. Now let's give you more information. So let's say on December X1, let's say on December X1, the company received the interest. The company received the interest on end of the first year. And that is, of course, 10%. That would be 1 lakh. Then I'm also given that let's say the probability of default is, let's say, to the extent of the PD is already given me, it's 0.5% is the PD. So the probability of default is given to me, and this is based on, you can say, 12 months ECL. This is based on a 12 months ECL. They've already calculated and given you a default probability that is supposed to be 0.5%. And now what we are estimating, the company estimates, the company is now estimating, the company estimates that we are going to get no further interest. There will be no collection. There will be no collection of interest now. They will not be able to get any interest in the future, and they will receive only 50% capital. They will receive only 50% of the capital money as well, that is 5 lakhs. So this is what the company estimates, that if a default occurs, then this is what they are going to get or not going to get. So we are given that as far as the credit risk is concerned, the credit risk they've made is low, because this is an estimation based on if default occurs. If default occurs in next 12 months, if the default occurs in the next 12 months, this is the estimation of the company, and the credit risk is low as on December X1. Right. I hope you got the data. Let me just consolidate the inputs, dots, and then proceed. So the company in this particular case has bought a bond which is measured at amortized cost approach. And I'm given the interest rate, and the effective interest rate is at the rate of 10%. So we're also given that the interest is paid every year end, and the principal is paid at the end of 3 years. We receive the interest at the end of the first year, and then sitting on the end of the first year, we made a credit risk assessment. It tells me it's low. But considering that if a default occurs in the next 12 months, the company is estimating no further interest will get collected, and only 50% principal will get collected. Now we are required to do the accounting. So let's proceed with the inputs. Let's ask you the fundamental question number 1. Is this within the scope of the standard? You purchase a bond at AC. Is it a debt investments at AC?
Yes, sir.
Yes, sir.
Absolutely. So it is definitely within the scope of the standard, because it is supposed to be a debt investments measured at AC. Second, considering that there is a low credit risk, which approach are you using? First of all, general or a simplified approach? It's not an account receivable.
General.
General approach, because it's not an account receivable, so a general approach. And when you applied a general approach, we looked into the significant increase in credit risk. It says it is low. So when it is low, you land up using a 12 months ECL in this case. And we are already given the PD based on a 12 months itself. Now we need to create a provision. What is the amount of provision to be created? So help me, please, and tell me what is the provision to be created. Last question, I gave you the provision amount directly, 30. Now tell me in this particular case, what would be the provision amount? We've got 4 factors: EAD, LGD, PD, and time value money. Time value money is certainly relevant in this case, because you are looking at the sitting on December X1, you're looking at the position till December X3. So more than 1 year. So naturally relevant. So can anybody please tell me, how would I calculate the provision in this case? Then I'll give you something more after the end of this calculations as well. So any insight, how would you calculate a provision in this case? Let me get aside, look at the data, help me. Okay, I think it seems I'll have to answer this question as well. Let me answer that. So let me take you here. So we are looking at the calculation of the provision for expected credit loss, and which is based on EAD into LGD into PD into time value of money. Now watch the calculations carefully. I am directly going to calculate the money which will not be collected. I am going to directly calculate sitting on December X1 the money which I am not going to receive. So let me just create a time scale to understand the picture well. So first January X1, then you can say December X1, then you can say December X2, and then you can say December X3. Let's look at the status of the interest and let's look at the status of the principal. So let's see the status of the interest and let's see the status of the principal. Can I say in terms of interest, we collected this interest on December X1, but it says no further interest is going to be collected.
Yes, sir.
And it also tells me that as far as the principal is concerned, only 50% will be collected. So can I say 50% will be collected and we can say 50% is not going to be collected?
Yes, sir.
So I am going to focus on the money which I am not going to collect, and there is no security given. So we can say the money which you can't collect itself is 100% loss on default because I don't have any security which I can realize. So let's do one thing. Let's make a small little chart where we can consider after the first year, after the second year, let's see the cash flows which I will not collect. Let's see the cash flows which I will not collect. Can I say interest is at the rate of 10% on 10 lakh? So you're not going to collect 1 lakh after 1 year, December X2. You're not going to collect that 1 lakh rupees and you're not going to collect that 50% of the principal.
Yes,
So
sir.
in my chart, I've taken the focus in terms of what I am not going to collect. So we've taken the interest collection on December X2, one, the interest collection on December X3, and the 50% of the principal. Can I say time value of money is relevant? So we'll do the discounting at the rate of 10%. So let's do the discounting at 10% to get the present value. So I think this will be 0.909 and this will be 0.826. So let's see the present value. So this is going to be 1 lakh into 0.909, that's 90,900. And this will be 6 lakh into 0.826, that is 495,600. So we add this up, it comes to 586,500. This is the present value which I will not collect. Now let me put a very simple question to you at this stage. Vouch me. So my question is this 585,600 the product of these three factors? Yes or no? The loss given default is 100%. So when you say what are you exposed to? I'm exposed to the fact that this is the money I will not collect. So can I say this is the EAD and you've already applied the time value money? So is this the product of EAD into the time value of money and the loss given default is 100%? Is that correct?
Yes, sir.
That's right. 586,500 is the product of the exposure at default into the loss given default. In this case is 100 because I have no security with me and the time value money is applied. So can I say I just need to multiply this 586,500 with the probability of default, and I give you the default probability in this case is 0.5%. Since I know that I will not get this money, but there is a 0.5% chance. So I will create a provision based on that there is a 0.5% chance of not getting money, but there is a 99.5% chance of getting money. So I'm not going to create the entire provision, but I will take the probability into account. So 586,500, and if we consider 0.5%, I think this is coming to 2933 if I'm right. Correct? Is this coming to 2933? So that is the amount of provisions to be created. Now, let me take the opportunity to add something further in this particular case. Now, there is one more thing which I think I should add at this particular stage. Let's, I think, give you that input as well. So let's create some buckets. There is a little extension of the inputs on the ECL model, which we need to understand as well. One aspect in terms of impairment is to calculate the amount of provision to be created in the books of accounts. But then there is another input as well, and that is once the impairment is conducted, how would you consider the finance income in the future period of time? Are you going to apply the effective interest rate on the gross carrying amount of the financial asset? Or are you going to reduce the amount of the allowance and calculate the interest income? And for this purpose, you know that the standard defines that there are three stages of a financial asset. This is the stage one. This is the stage two. And this is the stage three. So we've got three stages in terms of the categories of financial assets in this case. The stage one is when there is what you can say a low credit risk. The second stage is that there is a significant increase in the credit risk. And this is also a significant increase in credit risk. But you can say that this is as good as bad. This is as good as bad. You've reached a stage where there is an increase in the credit risk, but I know that this is irrecoverable in nature. So you can say this is like low credit risk. This is increase, but not bad debts. This is increase and it's bad debt, irrecoverable in nature. So what you need to also see in this particular case, if the company moves from a stage one to stage two, when you calculate the finance income, you calculate the finance income on the gross carrying amount itself. You calculate your finance income on the gross carrying amount itself. That means I will not reduce the allowance for impairment from the carrying amount of the asset to calculate the interest income. The finance income will be taken as the gross carrying amount into the effective interest rate. But in a situation where you're moving from a stage one to stage three, let's say stage two to three, in this particular case, the finance income which you're going to record is going to be on the net carrying amount in this case. You'll multiply the effective interest rate with the net carrying amount. That means in this particular case, when you calculate the interest income, you will take the gross carrying amount of the asset minus the amount of loss allowance, the provision for ECL which has been taken. So interest will not be accrued. Interest will not be accrued on the portion which is supposed to be impaired. So we will take the interest income on the net figure. Though in both the cases, there is a significant increase in the credit risk, but the significant increase means you need to decide that in this particular case, if you are in stage number two, you need to consider interest on the gross figure. But if you're in stage number three, you need to consider the interest on the net carrying amount. So this is the treatment of the subsequent accounting. So this is mapping you the subsequent accounting in terms of financial assets. The subsequent accounting of, you can say, financial assets post impairment. That once the impairment is conducted, and in this particular case now, you need to decide that what will be the treatment of the finance income. Right, friends, I hope I made sense on that particular aspect. So this was on the impairment aspect. I think now let's come to the next area of special issue discussion, which is on the accounting for embedded derivatives in this case. So far, so good. I hope you're comfortable now with the concept of hedge as well as the concept of impairment.
Yes, sir.
Wonderful
Yes, sir.
indeed. Wonderful. Now, I think let's go on to the inputs in terms of hedge accounting. Derivative, embedded derivative, which I'll explain with a practical illustration itself. Okay, so I think there is a small little question which is overlapping on the first and the next page. I'll just crop this up. So let's, I think, organize the data. I hope you can see the question. Right, the question is visible, I hope.
Yes, sir.
Great. So I am now, first of all, going to take you on the inputs which is given, and then we'll take it further. Let's read. So there's second part of the question as well. I think that would be readable because that's the first part. Okay. So let's, I think, read the inputs in this case. It says on 1st April 17, a company incorporated in India to enter into a contract to buy solar panels from Good Associates, a firm which is domiciled in UAE, for which a delivery is due after 6 months, that is on 30th September 17. So the company on 1st April entered into the contract, it says to buy a solar panel, and it's going to basically take a delivery 6 months later, and the purchase price of the panel is $50 million. Then I'm given the further inputs. The functional currency of the company is supposed to be Indian rupee, and the functional currency of Good Associate is dirhams. The obligation to settle the contract in US dollar is evaluated to be an embedded derivative which is not closely related to the host contract. Now, I'll not get into the nitty gritties in terms of derivative, because in this particular case, the question will always be telling you that whether there is a need to segregate the derivative embedded in the contract. So this is a standard kind of a sentence which you could read when the examiner would tell you that you need to segregate the derivative within the hybrid instrument. So it says that the obligation to settle in dollars is evaluated to be an embedded derivative, which is not closely related to the host contract, which means segregation of derivative is required. So we are given the exchange rate on 1st April. Then I'm also given this is the spot rate and this is the forward rate on 1st April. And I'm also given the spot rate on 30th September. We need to analyze and put entries in the books of accounts. So I guess let me just take you on the previous page. I think I'll just open the question in front of me so that I can easily manage it. Okay. So let's, I think, organize the data to begin with. Okay, I think let's use a fresh page for this. So question number 18, let's add it out here. So let's first of all organize the data in terms of question number 18. So I'm just organizing the inputs regarding the exchange rates which are given, and then we'll see how the accounting is done. So let's create a time scale. So first of all, let's consider a time scale. So I am given 1st April and I am given 30th September is when you're going to buy. So there is no balance sheet date in between. I'm not given the status of any balance sheet dates in between. So I'm just organizing the input. So on 1st April, you entered into the contract to buy solar panels. It says to buy solar panels in dollar. That is the transaction that you entered into to buy a solar panel dollar, though my functional currency is Indian rupee. Now, one thing is very clear, which I can say in generic. A company enters into a contract to buy or sell anything in other than a functional currency. You can say outrightly it would be a case of embedded derivative, because the contract is exposed to foreign exchange fluctuations in this case. So you enter into the contract to buy or you enter into the contract to sell in a currency other than functional currency. Undoubtedly, it will give rise to the concept of embedded derivative. So we are given that on this particular date, when we entered into the contract, the purchase price of the panel. So I'm given the purchase price of the panel is supposed to be $50 million. And I'm also given the exchange rates. I am given the exchange rate that is the spot rate on this date. I'm also given the forward rate on this date. So I am given the spot rate on this particular date is $1.60. I'm also given the forward rate on this particular date. $1 is supposed to be 65. I'm also given the inputs that the spot rate on 30th September is supposed to be 66. So I'm also given the spot rate, which is on 30th September, $1 is 66 Indian rupee. Right, so just organize the data. This is the transaction with the relevant exchange rates which are defined. Now, I always tell people that if you want to account for a derivative embedded in the instrument, the best practice is to write down the transaction and then split the transaction. So I follow the concept of what I call it as a split accounting. That you need to write the transaction in such a way that the derivative embedded in the instrument is gone. So see what we're going to do. The first art in terms of things, because I didn't give you a theory on this, because it's easy to explain with a practical illustration, you get the more connect on this case. So I didn't explain any concepts, I directly came to the question. So you need to first of all concentrate on this particular transaction and tell me how should I write this transaction so that there is no derivative in this particular transaction. Can I say only because you are saying that I'll buy these panels in dollar, there is a derivative embedded. What about a situation if I say that I'm going to buy these panels in Indian rupee? Can I say the derivative is gone? Agreed? Rewrites the transaction in such a way that the derivative is gone. The presence of this dollar is indicating that there is a derivative embedded. Change this dollar to Indian rupees. So we're going to rewrite the transaction. So we will rewrite the transaction, and you can rewrite the transaction to the examiner as well. And this will be that you buy solar panels, and in this particular case, you pay Indian rupees, that is INR. Now, let me ask you a very simple question in this particular case. Can I say in this particular case, my question now is there an actual receipt in INR or is there a notional receipt in terms of INR? At the end of the day, I'm going to pay dollars. So when I say that I am going to buy the panel and pay Indian rupee, is this a actual payment in INR or is this a notional payment in INR?
Notional payment, sir. This is
Notional.
Absolutely correct. This is going to be a notional payment because you are not making a payment in Indian rupee. You're going to make a payment in terms of dollar. So this becomes a notional payment in that case. So what do you need to do? Now you need to create a transaction in such a way that it creates a notional receipt in INR. You have to create a transaction in such a way that it creates a notional receipt in terms of INR. You have to define me a forward contract. You need to define me a forward contract in such a way that it creates a notional receipt in terms of INR. So what do you say? Are you going to buy dollars or are you going to sell dollars? In order to create a notional receipt of INR, are you going to buy dollars or are you going to sell dollars in a notional forward contract? Yes, I think somebody's put his hand. Yes, please go ahead. Okay, was that by mistake, I guess? Okay. So my question back to you, if there is a notional receipt which I need to create, so tell me what kind of forward contract are you going to create? Are you going to create a forward contract to buy dollars or sell dollars? Okay, I think I'll have to answer that as well. I am going to sell the forward contract. So we will enter into a contract to sell dollars because when you go to sell dollars, you're going to get Indian rupee. By the way, let me also ask you that is this forward contract an actual forward contract or is it just notionally created to do an accounting? Is there any forward contract as such?
no, sir. Only notional
No,
contract.
there is, yes, it's completely notional in nature. There is no forward contract. So the first step which you need to do in terms of accounting for a derivative contract is split the things. Let's do one thing. Before we proceed with the accounting entry, let's, I think, make one thing more clear. This can help you later as a summary chart as well. Since we're done the start of the question, let's create a small little summary chart in order to just get the dots connected. So I'm just creating a summary chart in terms of how the embedded derivative is accounted for, how you're going to rewrite the transaction. I would say there will be basically two kinds of transactions, mainly which you're going to see. Either it is to buy something, can I say in a foreign currency? Or can I say it would be to sell something, can I say in a foreign currency? So when you go to see the embedded derivative, you can be careful and you can just map your mind that there will be two kinds of situations. Either it is a contract to buy in foreign currency or the contract to sell. This undoubtedly would mean that there is a derivative in the instrument. Okay, now let's see how do you split. So let's say I'm saying that I will buy, let's consider we say that I am going to buy solar panel, let's say in dollars. And let's consider the transaction that I'm going to sell solar panels in dollars. So we'll see how do you split the transaction. So in order to split the transaction, you need to basically divide the transactions in two parts. So help me out with this two parts in the transaction. Can I say if I'm going to sell dollars in panels in dollar, I'll write down that I will buy. I'll rewrite the transaction that I will buy solar panels in INR. I will buy the solar panels in INR. So does it create a notional payment or a notional receipt?
Notional
If you say
receipt.
that it is buying in INR, notional payment or a notional receipt?
Notional receipt.
You're buying, you're paying, so it's a notional payment.
Notional payment. Okay.
Right. So what do you need to do in this particular case? Now, you need to create a transaction in such a way that it should create a notional receipt. You create a transaction in such a way that it creates a notional receipt. So notional receipt would mean that you're going to sell dollars and then you'll get Indian rupee. So we will create a transaction and tell the examiner that this is now going to be a forward contract, which is to sell dollars, so that we are going to get the Indian rupees, right? So the notional payment and the receipt will get offset. So write this transaction, give it to the examiner that this is the transaction without derivative. I will buy in INR, resulting in a notional payment. So to offset, I need to create a notional receipt. Now let's see this. If I say I sell dollars, solar panels in dollar, so I will say I will sell solar panels. Can you complete the sentence in which currency?
INR.
That's right. So it is going to be in terms of INR. That's correct. So if this is going to be in INR, now tell me, is it supposed to be a notional? Is it supposed to be notional payment or receipt? You're selling, so you're saying, I'm going to get INR.
Notional receipt.
That's absolutely correct. So in this particular case, it creates a notional receipt. It creates a notional receipt in this particular case. And now what do we need to do correspondingly? Tell me, what do we need to do correspondingly to cancel this off? Notional
Payment.
payment. So create a contract in such a way that it creates a notional payment in this particular case. I will buy dollars, sell dollars or buy dollars. If you buy dollars, you're going to pay INR and get dollars. So we will enter into a forward contract, and that would be to buy dollars. That would be to buy dollars. Okay, I'm getting a question. So can you please also solve the latest RDP on 109? I think I'll have to take time to that because I have some pre-decided agenda for the day. So no worries, we can do it in the next session. That's not an issue. Okay, so this takes care of the summary chart, which will give you how do you do the split accounting in this particular case,
Can
where
you
you get the
explain?
inputs that what is the notional contract entered. Right, friends? Clear with this agenda?
So can you explain this? Why are we buying solar panels in INR when we are buying solar panel in dollars at the
Okay.
top?
Okay. Uh, you mean to say that why I'm saying that this is converted in INR?
Yes, sir.
Okay. You see, the thing is that when you look at a concept that you're going to buy something in a foreign currency, will the outflow inflow fluctuate because of the foreign currency factor?
Yes, sir.
Correct. Now, this means that there is a derivative embedded in the contract. The movement in the exchange rate is the derivative. Had this exchange part not been there, can I say you would have paid a stable amount of money and it
So,
would
so
not
we are eliminating the embedded derivative element by changing the currency. That is it.
Absolutely, absolutely. So that is why I want to generalize the input that whenever you're going to see contracts to buy or sell anything in foreign currency, this means that the change in the exchange rate is the derivative embedded in the contract. So in order to do the accounting, 109 says segregate the derivative out of the contract. So when it says segregate the derivative out of the contract, so what we're going to do, change this dollar in a functional currency.
Correct, sir.
In
Clear, clear,
also
clear, clear.
change this dollar in a functional currency, but changing in a functional currency creates a notional receipt or a notional payment. Because at
Correct,
the
sir.
end, I'm going to pay dollars, I'm going to receive dollars. So it creates a notional payment outflow. So in order to do the accounting, a complete notional forward contract, we are not entering into any kind of forward contract. But we're just thinking that, if I have to create an opposite entry, a contra entry, canceling the receipt, canceling the payment, create a receipt, canceling the receipt, create a payment. So an artificial forward contract is being created, which is not being entered into. Correct. Right, so now let's come back on the agenda. So now we are going to look at the accounting. So in this particular case, I am now going to do the entries on 1st April and on 30th September. So let's begin with the entries on 1st of April. So let's see the entries on 1st of April. Okay, first of all, when I look at the entries on the 1st of April, can I say on the 1st of April, will you be doing any entries on 1st April when you are considering even a notional forward contract? Will there be any entry? Options involves an entry for payment, but in terms of futures forwards, no entry. So can I say no entries will be done? So let's come to the entries on 30th September. So derivative will be accounted under which head? Can I say outrightly mark to market, FPTPL? So we're going to record the derivatives at a fair value through profit and loss. So let's see the inputs on the derivative contract. Let's see the exchange rates. So can I say you entered into the contract at the rate of 65 and the spot rate at the end is 66. So is this a gain or is this a loss? We said that we are going to sell dollars. So you're going to sell dollars at 65. So if you're going to sell dollars at 65 to square of the transaction for cash settlement, can I say you're going to buy dollars at 66? And therefore it means sell at 65 and buy at 66. So are you going to get a gain or a loss on settlement? Your inputs on that, we said we are selling dollars at the rate of 65. So now you're going to buy dollars to square off the transaction. So is there going to be gain or loss on the
Loss,
settlement?
loss, loss.
Loss. So we're going to get a loss of $1, 1 rupee per dollar. How many dollars were there? 50 million. So let's look at the entry. The entry is going to be profit and loss gets a debit and you'll create a financial liability. Let's call this as a derivative financial liability. So we had a total transaction that was 50 million, right? So 66 minus 65, it was 50 million, correct?
Yes, sir.
Yes. So we get a total loss to the extent of 50 million in terms of INR. So this is one entry which will be done. Now, we also need to buy these solar panels. So we put the entry, solar panels gets a debit and the cash or the bank gets a credit in this particular case. So would you like to tell me what is the rate at which I am going to record? So I won't record cash at this stage. Let's better we record this as accounts payable. So what is the entry? What is the rate at which this entry is going to be done? Are you going to record this at a spot rate or are you going to record this at a forward rate? Though I have not entered into any forward contract as such. But the entire idea of doing this accounting is that you don't land up recording the solar panels at a spot rate because the change in the exchange rate is something which should get captured in the P&L. The change in the exchange rate should not get captured as a part of the solar panel cost. So what we're going to do, when you're going to record this entry, we will consider that 50 million into the forward rate. So what was the forward rate, I guess, 65? So this is going to be recorded at the rate of 65 itself. So let's see what is the value. 50 million into 65, that's I think 3250 million. Is there anything else which needs to be done? Is that financial liability which is there, is this going to be settled net in cash? Is there any actual forward contract entered? No. So can I make adjustments of that financial liability in net settlement cash? I cannot. So this amount will get adjusted in the creditors itself. So what are we going to do? This financial liability, which is a credit, will be debited at this stage. And this will be adjusted against the accounts payable. And I'll explain you the logic as well that what exactly is happening. So this amount to the extent of 50 million gets adjusted in the amounts of accounts payable. Now let's give you a few sentences and I think you can vouch me based on that. Can I say at the end of the day, if you look at the net impact of all these entries, vouch me very carefully, if you look at the net impact of these entries, I am thinking that if I want to look at the net impact of this entry, the net impact is something like this. Can I say your solar panel is getting recorded at a forward rate? The accounts payable is getting recorded at a spot rate, which is prevailing on 30th September, and this is prevailing on 1st April. And can I say any difference, which is the foreign exchange gain or loss? In this case, the foreign exchange gain loss is getting recorded in the profit and loss account. Am I right? So basically, can I say the crux of the accounting is that the panel is getting recorded at a forward rate, though I never entered into the forward contract. The liability is getting captured at the spot rate on 30th September. So any difference between the forward and the spot rate is getting transferred in the P&L. Is that correct? Nobody vouched me on that. Oh my God. I think let me put that once again to you. Let's first understand one simple thing. I think it's better to give you a little comparison on the stage. Let me ask you the question differently. Let's put the question differently to you. Let's consider no Indies and let's consider Indies. Now, let me ask you a very simple thing. Just look at this question and ask yourself a question. My company enters into a contract to buy a panel, no forward contracts. Are you going to put a normal entry? The solar panel will get a debit and the liability that is accounts payable will get a credit. Can I say at the rate on 30th September? Say yes or no. Was it 65, 66? Sorry. So what do you say? Is this correct? If I don't apply any indices, is my thoughts correct?
Yes, sir.
That's right. So when you would have entered into a transaction with somebody to buy the panels at a rate, there's no forward contract. So whatever is the rate on that date, I pay that rate and I'll land up recording the panels at the rate of 66. But Indus takes a view that, in this particular case, why should your solar panel get recorded at 66? It'll inflate the cost of acquisition. When you decided to buy the solar panel today, then in that particular case, any changes in exchange rate subsequently is not the cost to buy the panel. Mind the words carefully. If you decided that you're going to buy the panels on 1st April, though you're going to pay the money at a later date, why should you record the panel at 66? That's unnecessarily going to inflate the cost of the asset. Basically, the increase from 65 to 66 is the change in the exchange rate. It's not the cost of the panel. So therefore, ultimately, you need to record this at a forward rate 65, though I've not entered into the forward contract. But imagine, if you would have entered into the forward contract, you would have recorded the panel at 65. But recording it at 66 means you would land up capitalizing. You will end up capitalizing the amount of the exchange loss as a part of the asset, which is wrong. So in this particular case, your liability, of course, is going to be created at the rate which you're paying, that is spot. So this is forward and this is spot. And in this case, of course, you're recording a spot rate. So they decided that your liability will, of course, get created at the rate which you're actually paying. But the asset should not get recorded at that rate. So naturally, the movement from the spot to the forward rate, the difference of 1 rupee extra, that is something which is an exchange loss, and that exchange loss should enter the P&L. So therefore, the accounting was devised in such a way that if you get an exchange gain or loss, even though you have not entered into the forward contract, it goes in the P&L. So if you now see the net impact of these entries, you can clearly see that the profit and loss is getting a debit to the extent of that 1 rupee. The financial liability is getting a credit, the financial liability is getting a debit, that gets cancelled. And you can see that the solar panel is getting recorded at the rate of the forward rate 65 itself. And at the end of the day, the accounts payable is getting recorded at a spot rate. So this entry plus this entry creates an accounts payable at a spot rate. So the net impact is that you recorded the solar panel at the forward rate, the accounts payable at a spot rate, and any difference in the entry is a fluctuation of the exchange gain loss which enters the profit and loss account. I hope, friends, I'm making sense on the justification of the accounting treatment which is done for a derivative embedded in the instrument. Right? There's been a lot of... Yes, please. I hope I made myself clear, friends. I think that was quite a technical bit part on the standard, I guess.
Yes, sir. Yes.
Anyway.
Yes, sir. Yes, sir.
Great, wonderful indeed. So I think this brings us to the end of all the issues related to Ind AS 109. Now, before I end, I am just going to give you a quick inputs that you know how the order in which you are going to make your revisions before we close on this. It's very necessary that now the efforts are done, the financial instrument is done. Now you need to go in a chronological order in terms of making revision. First of all, when you start your inputs on the revision, just remember that you need to make a simple little thought process at the back of the mind. I'm not giving you details. I'm just giving you a thought process in which you need to proceed. So we know that there are two parties. One is the issuer and one is supposed to be the holder. You should be very clear with the classification aspects. You should be very clear with the classification aspects where we took a three-step model in terms of understanding the classification aspects. Financial liability, equity instruments, CFI. Here also you need to be very clear on the classification aspects, and even in terms of the classification aspects here, I gave you that there are three-step models to be done. The second aspect is the accounting aspect. Aspect is supposed to be the accounting aspect. And in terms of the accounting aspect, you should be very clear with the accounting of a compound financial instruments, the accounting for financial liability. No worries in terms of equity instruments, you may not get that. And similarly, when you're looking at the accounting of the financial assets, you need to be very clear in terms of accounting for both the debt investments and the equity investments, the various permutation combinations. And as you proceed, you can also consider that in this case, we need to consider the difference between the transaction value versus the fair value, where also I've done the three kind of relationships with you. That becomes a special agenda in terms of transaction value and a fair value as well. So this is how the accounting for this is going to be done. Then proceeding further, your mind should come on to the concept of derecognition. The derecognition of the financial assets and the derecognition of the financial liabilities as well. So on the concept of derecognition of the financial assets, in this particular case, I again gave you a three steps again. The three tests which were there, the cash flow test, the risk and reward test, and the control test. And in terms of derecognition, we did the concept of the 10% test, which decides the extinguishment accounting, and it decides the concept of, you can say, the modification accounting. And then we came on to the special issues on financial instruments. And the special issue one was on the concept of ECL not applicable to liabilities. So we did the concept of impairment for financial assets, but of course impairment does not apply to the concept of financial liability. And apart from this, we covered issues on the accounting for embedded derivatives and the accounting in terms of hedge accounting as well. That is how the entire mapping in terms of financial instruments is what I covered with you. Of course, there are fillers in between, and that fillers would be something which is separate. I'm not getting into those kind of fillers and all. So when you go to proceed, please do your revisions in a chronological order. Do questions from the study material, do questions from the past examination questions, RDPs and all, and you will get a very good hang, because undoubtedly financial instruments undoubtedly comes in the exams. Part of the MCQs and part of the independent questions. You cannot think of a paper without this. So that's the entire journey, friends, on the financial instruments. Our next phase is going to start on the consolidation standards, starting with the business combinations on Sunday and then going on to the consolidation. So in case of lesser, if only cash flows are modified and no space or lease term changed, how do we account for? We're talking about leases, I guess, not financial instruments. In case of lesser, okay, can you put this query, I think, separately, because I think that might go to the specific faculty who've taken the lease standard with you. It may not be appropriate for me to answer that in terms of lease. If you got a question on financial instruments, you said RTP question, I think, which you said, yes, we will take that up. Yes, I think somebody's put his hand. Yes, Monica, please go ahead. Accounting comes under Ind AS 109. You said in case of lesser, if only cash flows are modified and no space or lease term changed, how to account for. You see, Ind AS 116 also gives you accounting, which is quite similar to Ind AS 109, but it doesn't come under 109. When you consider a lease liability for that matter, it is a financial liability, but not accounted under 109. It's accounted under 116. So you cannot say it's under the purview of financial instruments as such. Okay, now I think you're looking at the inputs in terms of practical inputs. Let's not discuss the practical parts. We're restricting ourselves to the inputs on examination perspective. I think you're taking your inputs on the practical area. I will not give opinions on that, please. Right. Any further questions, friends, on your side? Otherwise, I think we're done for the day.
Thank you, sir. From my side, no doubt. It's a wonderful discussion had with you, sir. Thank you so much.
Thank you very much indeed. Thank you all of you for joining. So see you on Sunday, friends. We'll start with the business combination standard. Enjoy your days. We'll see you on Sunday. Thank you. Bye-bye and take care.
Thank you, sir. Thank you so much.
Thank you very much.
It's a beautifully drafted, sir. Instrument, financial instrument standards, with
Thank you
considering
very
all the
much
aspects,
indeed.
and you explained in the simple way.
Thank you very much indeed. It's a pleasure. I'm honored.
Thank you, sir.
Thank you very much. Bye bye. Haji, thank you. Same to you.
Thank